Welcome to our introduction to portfolio management, a cornerstone of successful investing. Whether you are saving for retirement, building wealth, or planning for future goals, knowing how to manage your investments is crucial. But what does portfolio management actually mean? It is all about understanding your risk tolerance, choosing the right mix of assets, and regularly checking your progress. With the right approach, you can make your money work harder while managing risk effectively. Today, we will walk through essential terms like risk tolerance, asset allocation, and alpha. This will help you better understand how to grow and protect your investments. So, let's dive into the key concepts that every investor needs to know to make informed strategic decisions. Let's start with risk tolerance. Risk tolerance is your personal comfort level with risk in your investments. It is about understanding how much risk you are willing and able to take on without losing sleep over potential losses. For instance, a young investor with a long time horizon might have a higher risk tolerance. He might be willing to accept market volatility for the potential of higher returns. On the other hand, a retiree may prefer less risky investments to protect their wealth. Understanding your risk tolerance helps you build a portfolio that matches your financial goals and personal comfort level. Understanding risk prepares you for the ups and downs of the market without making impulsive decisions. Next is asset allocation. Asset allocation is the strategy of dividing your investment portfolio among different asset categories, such as stocks, bonds, and cash. The goal is to balance risk and reward by spreading investments across assets. These assets should not respond to the same economic conditions in the same way. For example, if the stock market is down, bonds or other fixed income assets might perform differently, providing stability. Asset allocation is a critical tool for managing risk, as it helps ensure that all your eggs are not in one basket. Finding the right mix of assets depends on your risk tolerance, investment goals, and time horizon. Here is another important term, rebalancing. Rebalancing is the process of adjusting your portfolio back to your original asset allocation targets. Over time, as different investments grow at different rates, your portfolio can become unbalanced. For example, if stocks have performed well, they may take up a larger portion of your portfolio than intended, thus increasing your exposure to risk. By rebalancing, you sell assets that have grown and buy those that have underperformed to bring your portfolio back to its desired allocation. Regular rebalancing helps you stay on track with your investment strategy and prevents any one asset from dominating your portfolio. Next is alpha. Alpha is a measure of an investment's performance compared to a market benchmark. It represents the value that a portfolio manager adds or subtracts from a fund's return. For example, if a mutual fund has an alpha of 2, it means the fund outperformed its benchmark by 2%. Alpha is commonly used by investors to evaluate active management and determine if a fund is worth the fees. Positive alpha indicates outperformance, while negative alpha suggests underperformance. For beginners, alpha can be a useful tool for comparing different investments to see if they are adding value beyond what you would expect from general market movements. Now talk about beta. Beta measures a stock's volatility compared to the overall market. A beta of 1 means the stock moves in line with the market. A beta greater than 1 means it is more volatile, and less than 1 means it is less volatile. For example, a stock with a beta of 1.5% would be expected to gain 1.5% if the market gains 1%, but it would also lose more if the market declines. Beta helps investors understand the risk level of a stock relative to the market. It is particularly useful for comparing stocks with different levels of risk. If you are a beginner, beta can help you understand which stocks might be more volatile and decide if they fit with your risk tolerance. The Sharpe Ratio is a measure of risk-adjusted return, helping investors understand how much return they are getting for the level of risk taken. It is calculated by dividing a portfolio's excess return over a risk-free rate by its standard deviation. A higher Sharpe ratio indicates a more attractive risk-adjusted return, meaning the investment has a better balance of risk and reward. For example, if you are comparing two investments, the one with a higher Sharpe ratio is generally seen as a better choice if both have similar returns, but one has less risk. For beginners, the Sharpe ratio offers a straightforward way to gauge whether an investment's return justifies its risk. Next is standard deviation. Standard deviation measures the dispersion of returns around the average or mean, indicating how much an asset's returns vary over time. In investing, a higher standard deviation means more volatility, while a lower standard deviation suggests more stable returns. For instance, if a stock's standard deviation is high, its price is more likely to swing wildly compared to a stock with low standard deviation. This concept is helpful for assessing the stability of an investment. Understanding how much returns might fluctuate can prepare you for what to expect in different market conditions. For beginners, standard deviation offers a glimpse into an asset's risk level and potential return variability. Sometimes assets are related. Correlation measures the degree to which two securities move in relation to each other. A positive correlation means they tend to move in the same direction, while a negative correlation indicates they move in opposite directions. For example, stocks and bonds often have a low or negative correlation, which is beneficial in diversifying a portfolio. By choosing assets with low or negative correlation, investors can reduce overall risk. For beginners, understanding correlation can help in selecting a mix of investments. Creating a portfolio that is balanced and less affected by the performance of any one asset is what beginners should look for.